Welcome to the investment meeting of the Teachers Retirement Board for June 25th, 2026. I'll start by calling the roll. Joseph Borelli, Thomas Brown, Anthony Giordano, Nadia Fazulina,
Present for the mayor's office.
Victoria Lee,
Present.
Christina McGrath,
Good morning, Patricia. Present.
John Dorsa,
Present until my colleague Amy Slattery arrives.
And then he evaporates.
we do have a quorum. So first order of business is I'm calling for a nomination for the chair for this meeting.
I'd like to nominate Victoria Lee.
And I'd like to second that.
So all those in favor say aye.
Aye.
All those opposed say nay. Any abstentions? Okay, Mrs. Chair.
Thank you, Patricia. Good morning, everyone. We'll begin with an update on the passport funds from Amanda Denisov, GSAP.
Thanks, Victoria. Sharing here. Okay. So to start things off with an update on the passport funds, we have our flash through the end of May that's been posted to convene. The passport funds had another positive month in May, so ended as of 5/31 at $25.4 billion in total assets, which was up from about $24.4 billion as of the end of April, so about $1 billion in growth over the course of the month. And that's really due to a continuation of the equity rally that we saw in April, coming out of what was, of course, a very difficult March. That rally has continued to be led by AI-related stocks and also supported by positive earnings surprises as well as strong U.S. economic data. On the flip side to that, offsetting that somewhat has been continued high energy prices and continued uncertainty in the Middle East. We have seen major central banks holding steady, including the U.S. Federal Fed, which did meet again here in June just last week and continued to hold rates steady, although they have been signaling certainly concern for heightened inflation and potential for a need for more tightening of monetary policy, although I will note that it's our view that we are expecting rates to remain flat through the end of this year. For performance for the month of May, we saw across equity markets, U.S. and non-U.S. returns in the sort of 3.5% to 5% range. So you can see the Diversified Equity Fund, which represents around 90% of the assets in the passport funds, up close to 5% for the month of May, with the strongest results coming from the International Equity Composite. Active management has continued to be a bit of a lag over the last year, really across the board, and you can see that reflected here, particularly among the active U.S. equity composite, which has underperformed its benchmark both for the month and over the trailing 1 year. Looking out over the year-to-date and 1 year, also very strong results. So despite that sell-off that we saw during the month of March, this very strong rebound in April and continuation into May, you are ending year-to-date for the Diversified Equity Fund at over 10% gains. And for the 1 year period ended May, 27% return for the Diversified Equity Fund. So we are lagging the policy benchmark somewhat, again, due to the results of active management, but very strong absolute return. Certainly 27% on a 1 year basis is a very strong outcome for the year. So in terms of some of the other variable funds here, the balanced fund, of course, being your most conservative option, has had the lowest returns for both the month and the year, returning but still close to 11% on the 1 year period through the end of May. I'll pause there unless there's any questions on May results.
Are there any questions?
hold on, I buried that, so let me put that back. I know. All right. Yeah.
Now watch him magically disappear before your very eyes.
Morning. Good morning. Okay, next I believe we have Dan Haas from BAM.
Good morning, everyone, and thanks again for indulging me. I'm sorry I couldn't be in person today. I had a bit of a tight schedule this morning, so this is definitely helping me out quite a bit. Why don't we jump right in and take a look at just some of the more recent metrics? It's only been a few weeks since we last spoke, but give you some quick highlights. Economic growth, the GDP prints. Worth noting that, and I'll back up a little bit. Perhaps explain how these work a little bit. Every quarter, there's sort of an advanced reading, a second print, and a third. The third print for the U.S. GDP actually just came out this morning. So instead of that 1.6% we saw for their second reading, more data came in. That's been revised upward to 2.1%. So nice positive development there. Again, stronger than the last quarter's final results. And supportive of healthy economic growth, particularly relative to our developed peers. As we kind of look down towards CPI, as you recall, of course, that was very much the values that we've seen over the past few months have certainly been elevated compared to what we'd seen, say, in the last year or two. And that is very much an energy-driven story, as you'll recall. Obviously, with the memorandum of understanding being signed and good faith negotiating efforts to cease hostilities with Iran, that those concerns seem to have alleviated considerably. We see crude oil, dropping from the $100 a barrel context down to about 70 or 75 today, to kind of pre-conflict levels, and that certainly alleviates a bit of the concerns that we saw, and certainly some of the upward pressure that we've seen in the CPI. As you may recall, a couple weeks ago when we were discussing it, we saw some elevated levels and upward surprises in the producer price index, which is driven a lot more by commodity pricing, and we're seeing it also kind of flowing through to the headline CPI and also even a bit into the core CPI as those effects have trickled through. So hopefully this turns into more of a durable piece, and that pressure is alleviated and we normalize kind of from here. Moving over to the U.S. job market, same story that we've had before. Obviously, even Steven there. The most recent print for May is at 4.3%, unchanged from the prior month, as is the labor participation rate. If you look at labor participation for prime age workers, again, it's in the low 80s, near its all-time highs. So a positive sign there that we are an economy near our natural rate of unemployment, and labor is participating and obviously consuming as well, right? So again, good signs for the economy. Payrolls themselves, not sure I'd call them robust, but they have been increasing over the past few months. You can see that the May print came in at 172,000 new jobs, a little bit ahead of the 88,000 consensus that we had. And again, another positive number compared to the April at 179,000 jobs. And then finally, those currency rates, we're seeing some strengthening of the U.S. dollar. That's, again, driven by when you compare, these markets, just comparative changes in inflation expectations and economic growth between the U.S. and these various markets. So, there's a very positive trend, say 3 or 4 months ago that we were discussed, where the U.S. dollar had weakened. That seems to be reversing a little bit these days. So you see a bit more chop there, and other currencies depreciating relative to the U.S. dollar. We move on to our rates on the next slide. Thanks. The development here, of course, the inflationary concerns have obviously shifted, and again, it's the same story we've been selling for the last few months. shifted our uncertainty toward policy direction to a little bit more certainty of sort of a higher for longer rate regime, particularly in the United States and among our developed peers. You can see that the ECB and Japan each raised their rates in the last few weeks. ECB went up by 25 basis points from 2% to 2.25%. Bank of Japan increased theirs from 75 basis points to 1%. Again, those are largely viewed as reactions to fresh inflationary pressures, although for slightly different reasons. Japan's more normalizing, whereas the ECB is reacting more toward the energy-driven inflationary concerns. Nevertheless, you see them increasing rates. Our outlook, as you'll recall, of course, is as Amanda mentioned, likely no cuts for this year. Possibility of even an increase toward the end of the year, but again, very much data driven and wait to be seen. But I'd get comfortable with that 3.75% at least for the near term. The spreads, corporate spreads, if we look at the top right there, again remain near their 20-year tights. A good indicator, of course, that money is flowing freely into those sectors, and investors are not demanding significant premiums for investing in them. And then finally, as we look at the Treasury curve, as you recall, last time we spoke, I was showing you two charts two lines on that chart that showed how the yield curve had shifted upward by we'll say on average about 0.5%, 40 to 60 basis points. And the story then was, again, that was this market pricing in a new inflation regime and demanding extra compensation for that change in expectation. This time around, we're seeing that as we ran this as of last week, you see that the curve is bumped up in the 2-year, but not as much in the 10-year. So we have a flattening of the 2-year, 10-year spread. If we were looking at this a few months ago, it was closer to the 50 basis point positive spread range. Now we're down to about 28 basis points. And again, that is more of a policy driven change as opposed to an economically driven change. Again, the expectations are that the Fed is very sensitive to, the policy is driven by policy changes or changes in policy expectations are expressed more in the 2-year range rather than the 10-year range. And the expectation is that the Fed will remain higher for longer. And you kind of see that manifesting itself in the flattening of that 2-year, 10-year curve. Moving over to the rates themselves, you can just kind of see that playing out from where we were 3 months ago. 28 basis points today as opposed to about 48 basis points, in March. You see that also playing through with the 30-year fixed mortgage rates. The discount that we had versus last year now, as opposed to 3 months ago, has certainly narrowed. So rates are down a bit, but not as much as we saw them, when we were talking last quarter. And gold as well. Gold is sold off again. We're pretty far off of our recent highs of a little more than $5,000 an ounce. Now closer to 4,200. Again, just an unwinding of that trade as well, as capital seeks other sources of return. Before I move on, is there any questions I can answer on this material?
Any questions? No? Okay. Now Dan will provide us a preliminary performance data update.
Great. Excellent. So again, this is what we like to call a flash report. These are your preliminary returns through the end of last week. Of course, you've been reading that there's been a bit of chop in the tech sector first couple of days this week. That largely seems to have been retraced. I mean, there's a bit of a sell-off there, and then we found that Micron it's a U.S. chip manufacturer, reported what was it, a 15-fold increase in profits last quarter, which is quite an increase. And animal spirits seem to have returned to that sector, and we see Nasdaq trading up pretty significantly this morning. Nevertheless, the chop that you saw earlier this week is just that. It's investors kind of repricing their exuberance in that space. If I were to rerun these numbers as of yesterday, you might expect, say, a 60 or 70 basis point reduction from the numbers that you see here, where the cutoff was last Thursday, the end of last week. Nevertheless, positive returns, as throughout the various sectors that we're invested in, looking at about 13.5% return, maybe a little bit lighter as of today, but great results so far for the year.
Could you let the record show that Anthony Giordano has joined the meeting?
Are there any questions?
Great.
Thank you, Don.
Thank you, everyone. Have a great day.
Thank you. That concludes the business of our public session. I will now entertain a motion to enter into executive session to discuss recommendations from mail.
So moved.
Thank you, Christine McGrath. Do I hear a second?
Second?
Thank you. All in favor, please say aye.
Aye.
Any opposed? We will now move into executive session. We are now in public session, and we will have an official readout from Priscilla Bailey. Priscilla, whenever you're ready.
Thank you, and hello, everyone. The following provides a summary of agenda items covered in the executive session of the June 25th special investment meeting. In the executive session of the Passport Fund, there was a manager update. In the executive session of the Pension Fund, there was no manager update. There were 2 private equity presentations. Consensus was reached on both. There was a real estate presentation. Consensus was reached. There was an update of a contracting matter. And to that end, details to be made public pending further action and at the appropriate time. Thank you.
Thank you, Priscilla.
Thank you.
And having concluded our business, I will entertain a motion to adjourn today's meeting.
So moved.
Thank you, Ms. McGrath. Do I hear a second?
Second.
Thank you, Mr. Giordano. All those in favor, please say aye. Aye. Any opposed? The motion carries, and this meeting is officially adjourned. Thank you, everyone.